Hey everyone, my name's Michael, and as was mentioned, I'm going to do my best not to put everyone asleep. So, aside from educating, I will try to avoid talking too much and being too boring, which, as a lawyer, admittedly, is kind of hard to avoid both, but we'll do my best. So, anyways, before I get into maybe just quickly introducing myself and giving you just a small bit of background about Osler, could I get a show of hands for just who in the group, just so I know this audience is a founder? Okay, cool, awesome, wow, good contingent. Investors? Yeah, okay, awesome. And just someone that you would characterize yourself as kind of a stakeholder in the ecosystem, interested in tech, supportive in one way or another. Okay, cool, awesome. Okay, cool. Okay, so today I'm here to talk about organizational and governance structures and best practices. So before I get into that, I'll just give you a little bit of background on Osler and try to hopefully qualify a little bit of why I should be here even speaking to you and offering this advice in the first place. So I'm a partner in Osler's Emerging and High Growth Companies Group. I lead that practice in the prairies, so Alberta, Saskatchewan, and Manitoba. Osler as a firm, when it comes to our emerging and high growth companies practice, is the largest legal practice for tech and venture capital work in this country. We do a lot of financings, for example, every year. We've got well over 1,500 clients in the space. We're doing on average about 300 financing transactions a year. When you think about the total kind of CVCA reported venture capital investment numbers each year, Osler is responsible for more than half of those transactions every single year, either as company or investor counsel. And so we've got, great perspective on both sides of the fence, kind of seeing things from a company and investor side and at all stages. So, I work personally with companies at very early stages to very late stages. So, think about a founder at the ideation stage, even before incorporation, through to a late stage Series D or E financing transaction or kind of IPO readiness, kind of everything in between. And so that comment, in my view, is just really important for today's conversation, because whenever I'm advising clients and thinking about organization considerations, governance considerations, how to set these businesses up, I'm not thinking about it from the perspective of just like, how does this work next week? And are you happy today with how this looks? But rather, how are we setting up fundamentals for your business for the next 5-7 years as we think about your trajectory as a company towards an exit or multiple rounds of financing? And so that long-term view, the volume of work that we do as a group, is all really important from my perspective, because it really feeds into we've seen all these things at the Series C and D stage. And so how can we set the groundwork to manage those things today when you're setting up a business or in the early days? So trying to avoid making this sound like I'm just patting myself on the back for all the work that we do, but I'm hoping to at least convey that we do a lot of work in the space and have a lot of insight into some of these things that we're going to talk about today. Okay, so today's agenda, practical conversation about organizational and governance structures and best practices. And really what that means in simple terms is, how do we set businesses up in a way that they're structured, at least from a legal perspective, for success and not to encounter roadblocks down the road. So key topics that we'll look at: board composition, shareholders and shareholder management, importantly, equity incentive plans, cap table hygiene, employees, and IP ownership. So why does it all matter? Why does any of this matter that we're discussing today? Failure to do some of this or to structure things properly can stunt your business growth, can make it very difficult for investors to invest in the business, can create huge distractions for founder teams and disputes down the road if things don't go as planned, or people have things in their life that happen where they're no longer able to participate, for example, in building this business that you all set out to build on day one. And depending on how long it takes to realize these issues and then ultimately correct them, can have tax implications for people, which there's a lot of kind of theoretical risk whenever you're dealing with private company stuff. Tax is not a very theoretical thing, and tax liability is a very real thing. So we try to avoid that as much as we can, and sometimes a lot of that work to do that and to set a foundation for that starts at the beginning. Okay, So board composition, and this is a 101 presentation, so bear in mind some of it will be kind of very early stage in perspective, but we will try to think about, what this looks, as I've been mentioning, kind of over the long term as well. So very basically, board of directors, they are tasked with managing the business and affairs of the company, and their legal duty is to act in the best interest of the company. And so when you're a director, you're a founder of a company, you're also going to be a director most likely. You have a legal obligation to act in the best interest of the company. That incorporates a bunch of different stakeholders in your business, including the shareholders as you have more, your employees, creditors, et cetera. The best practice to start is really an odd number of directors, which seems admittedly pretty straightforward, but I can't tell you the number of times we've had people say, okay, well, we'll just have 2 or 4, or all 6 of these founders are going to be directors. And that can sometimes be a recipe for disaster where people can't seem to agree. And so ideally, you have an odd number to start where you can deal with deadlock. I would also say in the early days, it's really important to keep board structure simple. So, and this is a general theme you'll see in everything that I have to say today, but the more complex you make things, the harder it is. And I should back up maybe. Whenever I'm helping set companies up, I'm doing so with, as I mentioned, what is in the long-term best interest from a growth perspective for the business, but also what creates the most kind of simple, efficient, within reason, structure for investors to rationalize your corporate governance and what it means to invest in your business and be potentially on your board, be a significant shareholder, and have oversight as well. So the more complex we make things unnecessarily, the more challenging you can sometimes make this from an investment perspective down the road. So bearing that in mind, simple board structure is ideal. Keep the numbers lower if you can. Obviously, there are circumstances where that's sometimes not possible, but if you can manage a 3-person board, for example, I think that's an ideal at the early stages, and then that board will change and over time with financings that you complete. And so generally speaking, the early days of your company's board structure, it will be a founder-controlled board. Over time, as you start to get into you've done a pre-seed round, you've done a seed round, now you're doing a Series A or a Series B, that's kind of the inflection point for when you start to see your board composition change and where you start to see more investor control in your board. And so just to kind of be aware of retaining founder control as much as possible in the early days, that's important. And it's also not atypical. So keep that in mind, but know that starts to change as you start to get into later stages of fundraising. In terms of, and we'll cover a lot of these best practices today, but one best practice is to just tie board nomination rights to actual engagement by the company in shareholdings. So the worst possible thing you could do is give a co-founder just an indefinite, no strings attached board right, because if they leave for any reason, they're still on the board regardless of how much they're involved, how much equity they hold, whether they're leave on friendly terms or not. They're on that board and they're going to frustrate the operations going forward of the business. And so really what you want, and what is fair, frankly, is for all of your board members to be actively engaged by the company, at least on the founder side. So if you're a founder, you should be expecting all founders who have board seats to be engaged by the company and to hold some minimum threshold of voting shares, which we'll get into the importance of voting shares versus non-voting later on, but to hold some threshold of voting shares. You don't want someone who's no longer, working 36 hours a day and doesn't hold equity in the business or, a meaningful amount of equity in the business, making decisions which impact the business at a very large scale. So having some kind of off-ramp for departing founders at the board level is also really important. Okay, so shareholders and shareholder management. So typically the shareholders in the early days are just the founders. You may have employees, contractors, advisors who are also involved, and generally they'll hold options, so typically not shares. We'll get into that a little bit later as well. But there are kind of governance questions that arise from shareholdings, and sometimes it seems simple, like we've got two founders, let's both be 50-50, or we've got 3 founders, let's be, a third, a third, a third. And while that may be the right answer, I don't think it should always be assumed as a given, because you really have to look at what do shareholder votes mean in the context of approving material decisions. So if you need a majority to appoint your board every year, or you need 2/3 to amend your articles in connection with the financing, and the shareholders, every single shareholder has a block, maybe there's a reason to get comfortable with that in the early days, but just know that those voting dynamics matter. And if you have set up shareholdings in a way where all of the founders have a block, I mean, that just means every single person has to agree all the time, and that doesn't always happen. So while that may still be the right answer and the outcome for your particular business, just be cognizant of the fact that blocks do come to matter sometimes if there's disagreements, and there should be some thought to weighting sometimes percentage ownership. So if I'm a founder in principle, but I have a day job and I'm committing maybe a few hours a week to this business, and my co-founder has quit their job, is spending every waking hour on this business, has probably lent the company some money as well to pay its bills, probably not realistic that we're 50-50. And I would also argue that if I'm only willing to commit a couple hours a week, that might be a bit of a sign that I'm not fully in on this. And so query in that situation, is it right for me to have 50% of this business in that scenario? And it may be, and that may be the answer, and there's reasons to do these things, but it's a conversation is, I think, really what I'm trying to encourage here versus just an assumption. The other thing to keep in mind is, and this is this last point here as a best practice, so be hyper vigilant about equity ownership and how much equity you're giving away as time passes on, especially in the early days. There are kind of accepted bands for what senior executives, contractors, rank and file employees, consultants, advisors should typically get in the form of equity or options. And one mistake I've seen companies make all too often is in the early days, give away large chunks of equity to people who, unquestionably add value for sure, but perhaps are just very kind of tangentially involved in the business. And when it comes time to actually raise a round of financing, those seemingly, it's only 2%, it's only 4% equity allocations actually come to hurt quite a bit from a dilution point of view. Because the thing that sometimes people don't get is when you raise a round of financing, you not only just have a pre-money valuation and then a resulting share price based on your capitalization, like the shares that are outstanding at the time, but the value of an increase to your equity incentive plan or your option pool to have the right number of unallocated options post-closing, the dollar value of that is a reduction to the pre-money valuation that you get in your round of financing. And so if you've blown up the pool in the early days, granting options to people in a way that just hasn't been super thoughtful, there's going to be a pretty hard correction as part of your financing where investors say, you have no options to be able to issue employees going forward. I don't want to be diluted after I invest my money because you have all these plans to issue options. I want you to create the option pool that we need after closing on a pre-closing basis. And by doing that, that comes out of the pre-money. So they may say, you've got 0% of the equity in the pool available. We want you to have 10%. Well, that's pretty meaningful in terms of the dollar value of that 10% in the context of your financing when you multiply the number of shares by the share price for the round. So anyways, that's all just kind of the importance of being really on top of dilution. And that becomes increasingly more important as time marches on, because a really key thing investors are always looking at when they're evaluating an investment in a business is, so these three founders are the people leading this business. Are they the right team? That's obviously very important, but also do they have enough skin in the game to be, basically working for free over these next few years and continue to be motivated. And so if you're super diluted, don't have a lot of equity in the company, investors are going to look at this as a more risky investment, because there's nothing really, if I hold 5% in this business and I'm a founder, what is really holding me here in this business after they've put in a few $1 million in a seed round to continue to push and continue to make, even after we close around $50,000 a year, there's a trade-off in those early days in terms of compensation, and that equity needs to be a big factor in that. And if you haven't set things up in a way where you hold a material amount of equity heading into a financing, and over time can make things difficult for you from a fundraising point of view. The other thing to keep in mind is reverse vesting arrangements are super important, and it seems, maybe just to back up, so for anyone that's not familiar, reverse vesting is this idea that, Michael gets 100 shares on incorporation, and those 100 shares vest over 4 years, and with a 1-year cliff. And what that basically implies is that if I leave at any point in those 4 years, the company can purchase back from me, from my 100 shares, the number of shares that have not vested. And the way the shares become vested is just over time, my engagement with the company. So over the first year, nothing vests, but at the 1-year anniversary, the way we usually like to set these up, which is kind of consistent with the Valley and how they do things in the US, 25% of my 100 shares vest. So after 1 year, 25 of my shares are free and clear. And if I leave the business, I keep 25 shares, and the company has a right to purchase 75 shares after that 1-year anniversary. After that 1-year anniversary, the remaining 75 shares vest in equal proportions at the end of each month over the next 36 months. And I still vote all of my 100 shares. If we sell the business, I still sell all of my 100 shares. It's not like options where you get this accruing right to buy something, but rather you still own them on day one. The company just has the ability to buy them back if you leave. And that is so critical, and it may sound counterintuitive. I'm a founder, I'm putting all my time into this business. Why should I have exposure to lose all of my equity for this thing that I'm literally pouring everything into? The reason is every investor, most investors, especially in the institutional ones, at your seed round will insist on vesting. And so as a practice, I usually like to set this up at the beginning, because if you're 2 years into your vesting schedule when you raise a round, it gives you some conversation with the investor to have around why you shouldn't start the clock all over at 4 years, because they will insist on you vesting. Back to my other point before, the founders are basically the business in the early days. And if you're not around, there really isn't a business, and that's a huge problem for an investor. So they're looking at this as like, what are the ways we can incentivize Michael to stick around so he doesn't leave this business, because we don't want to run it. We don't know how to do what he's doing. And so that reverse vesting is a way to do it. We want things to be balanced. So ideally, a 4-year vesting schedule after you've already been building this business for 2 years probably doesn't feel very fair, and I would agree with that. So if you can start it earlier, you have a bit of a conversation to have at least, or a basis to tell the investor, hey, I'd like to keep, we've been responsible, we've got a vesting schedule in place, and we'd like to keep it. May not work, but at least it's a conversation, which is better than nothing. Also, though, if I hold 100 common shares and my co-founder holds 100 common shares, and my co-founder decides this life isn't for me, it's a tough life, which it is, but it's also a very rewarding one. This vesting arrangement gives the company the right to buy that co-founder's shares back, or at least the unvested portion, and gives me then the ability to go out there and find another co-founder and issue, either those 100 or a portion of those 100 common shares, whatever has been repurchased, to that new individual. Alternatively, if I didn't have a vesting arrangement in place and that co-founder left, I now have a 50% shareholder who has no involvement in the business, who may not even like me at this point, voting on important things. And also, if I do find someone else that I really like that I want to bring onto the business as a founder, I now have to issue that person new equity, which dilutes me and the other founder, just to bring this individual on, which, I didn't leave the business. It's not quite fair that I'm being diluted as a result. So, that's kind of the thinking on two fronts, really. And that's kind of an important shareholder management point. The other thing I would say is think about using a class of, and usually what I do is a class of common shares that are issuable in series as voting and non-voting common shares. And the reason why I do that is I give the founders and kind of, key shareholders who are actually engaged in the business at a kind of material level voting common shares, and employees, contractors, advisors, et cetera, going forward get non-voting common shares. And this is important because that consolidates power in the founder group going forward and is responsive to the dilution point that I mentioned before, at least from a voting perspective. But at the same time, for folks that are kind of like rank and file employees that are maybe getting, 0.1, 0.15% of the company in an option issuance, does it really matter that they have a vote or not? Because they can't really control anything anyways. And besides, options are really an economic incentive. They're a supplement to compensation. So, you're not necessarily always giving employees options with a view to like, hey, we want you, employee, to be helping us make decisions on a day-to-day basis, but rather, hey, we're not paying you, $500,000 a year like you could get if you worked at Google. Instead, you're going to take a risk on us, and we're going to make sure over the long run your equity is worth it. That equity is an economic incentive versus a voting incentive. And so for that reason, I usually view founders holding voting common shares. Obviously, investors in the future, as they invest, will get preferred shares, or if it's a pre-seed round, like a SAFE or convertible note, which converts into preferred, and then everyone else gets non-voting common shares. So that brings us to the equity incentive plan. And this is such an important tool to have in place in the early days. So whether you call it equity incentive plan or an option plan or an ESOP, it's all the same thing. So it's a way to give equity to your employees, to contractors, to independent directors perhaps that come onto the company later on, to advisors. And there are a few different tools that you can have in this equity incentive plan, at least when we're doing this work. One is options. So options simply are an accruing right to buy common shares in the company. So, over time, as I continue to stay engaged with the company, I have this right to buy the number of common shares that are kind of evidenced on my option agreement. At an exercise price that's agreed, and typically, that exercise price is pretty low at the beginning. Restricted shares, which are basically shares that are issued from the pool. There's no accruing right to buy them. You just get in my example that I mentioned before, maybe 100 common shares, and similar to the reverse vesting arrangement that I discussed. Those restricted shares also have a vesting schedule. So same exact thing. Like I may get as an employee 25 common shares, and those common shares vest over that 4-year period with a 1-year cliff. And then finally, you've got restricted share units. And really, that's a later stage tool for equity allocation. And basically what it provides for is that you basically get this contingent right to have shares in the company. And it's contingent because you basically get this award of shares as part of a liquidity event. So maybe a sale of the company, an IPO, and that's usually a tool used by later stage companies only because it's a fully taxable issuance, but you're getting those shares at a time when you're actually getting matching liquidity, or in theory, when you're getting matching liquidity. So you're getting cash to pay your tax bill. That's important where you're a really late stage company, you've got a share price of like $100 a share, and there's 30 million shares outstanding, and you don't want to get an option because you're going to have to pay a really large exercise price to get the shares, or alternatively, you don't want to just get restricted shares for nothing because you're going to have a huge tax liability crystallized right immediately at that point. So RSUs are not an early stage tool, but become important later on in the game. And then for the best practice that I have for these equity incentive plans, it's really important to think about these plans as having all of these ingredients from day one. You never know, when the time is going to be right to use that. And it's really nice to just be able to pull that tool out of the toolbox and use it, as opposed to, oh, hey, none of the stuff that we have works. We've got to amend the plan. We've got to get board approval. Maybe we have to get investor approval down the road. If there are, U.S. Tax structures in the plan, which I usually recommend there should be, you may have to get shareholder approval from, I know this sounds weird to say this, but from an IRS perspective in the U.S. But the key is to kind of have some of these structures in place early on. And Osler and any other law firm that is really good at doing this work has resolved that chicken and the egg issue of yeah, that sounds like a lot of work, and it sounds like I'm going to bill you, $20,000 to do this, but that's not the case. We can do it for we do all of this work, we get all of this stuff in place for a flat $5K fee that we defer for up to either 6 months or $100K in commercial revenue, not financing revenue. So all of this stuff should not be rocket science for your legal providers. it should be done on a very cost-effective basis. But the key is that as an early stage company, these things shouldn't be off limits to you simply because your budgets are very finite. And so just keep that in mind in terms of people you speak to. You should still have everything you need from day one, and your advisors should be able to help you figure that out. Okay, so equity incentive plan continued. So again, thinking about best practices and how to set these things up. Generally, the kind of typical allocation of your pool is about 10 to 20% of your fully diluted capitalization. So, if we started this company with 10 million shares outstanding, and 15% of that is 1,500,000 shares. That's pretty much bang on right in the middle. And so anywhere between 10 to 20% is pretty typical. That said, this next point, road mapping is really important. So there's an element of, yes, I can tell you 10 to 20% is pretty common in terms of what we see, but there's also an element of, as a founder, needing to think about, what do I actually need to hire people? When I think about my hiring roadmap, the folks that I need to help build this business in the early days and my needs to kind of re-incentivize people with equity, what do I think I need? Do I need 1.5? Do I need 2 million shares, or 20% in my example? And so there's an element of just thinking through, what are the needs of the company, and the number is just the number, but it should really be underpinned by a bit of thinking around what's actually required. Kind of back to this best practice, and I mentioned this already, but typically non-voting common shares are the best idea for people receiving option or equity awards from the pool. Again, this just helps continue to consolidate some of the voting power within the founder and common share group. And as I mentioned before, this is really an economic incentive tool as opposed to, hey, employee, we're giving you these options because we want you to be, on the board or helping us run this business, which is not the case. And then moving on, so cap table hygiene. So a cap table is a really important tool because at the end of the day, as much as myself or any other lawyer will, try to, seem as important or relevant as they can, everything that founders do in the early days and going forward is about numbers. It's not about words. So law is mostly about words. These businesses are about numbers. They're about, ownership. They're about dilution. They're about voting power. They're about exit potential. And so all of the words kind of flow from like the shareholder agreements, the vesting arrangements, everything is all in service of the numbers. And so cap tables are probably one of the most important expressions of the numbers involved in your business and what you're doing. And everything that we do as lawyers, accountants, et cetera, all based on and predicated on those numbers ultimately. And so for that reason, cap tables are super important. In the context of a financing particularly, they help investors understand, what do I own of this business? What does the founder own of this business after we close? Again, to my point of skin in the game and making sure that as a founder you have enough of a future economic incentive to continue working every single waking minute of the day on this business. Investors want to know that you're going to be around for the long haul. Like, they don't want to put in $2 million and then have someone decide, yeah, this really isn't for me. Good luck, investor. Like, that's not what they want. And so numbers are important from that perspective. Cap table is a good visualization of that. Key elements of a cap table, and maybe just to back up, I should explain this. A cap table is basically an Excel sheet which sets out, Michael owns, 75% of the common shares in this business. Shareholder number 2 owns 25%. There's some other options, et cetera, that are issued and outstanding. And it's basically just what's the number percentage of Michael's votes in the company at this early stage? What is Michael's ownership on a fully diluted basis? So, if the company was sold for $100, how much of that does Michael get? And that cap table really helps visualize that math. And also is kind of where all of the magic happens when an investor is making an investment in your company, because that's where we model out, okay, so you've got, this pre-money valuation, you've got this capitalization, you've got these safes and convertible notes outstanding. At the end of the day, once this investment is closed, what does the ownership of the company look like? And we can work that out through the cap table. Total side note, I went into law to get away from math because I hated math and I was horrible at it. And in this twisted turn of events, I'm now working on cap tables like every single day. And it's actually one of the best parts of the job, frankly, because I do enjoy it. But if anyone here is considering a career in law to get away from math, this practice is not the one for you. But anyway, so that's a cap table. Key elements of a clean cap table and things that I would look for. So I would ask, is it up to date? If I get a cap table from a client, they're like, yeah, this is from a few years ago. Half these people aren't even shareholders anymore. We're going to have to figure that out. Not a great cap table, obviously. Is the capital structure simple? And so when I say the capital structure, I'm referring to, what the company has authorized as shares. And so, my preference always when I'm setting things up is to keep it simple, unless there's a reason not to. But again, I err on the side of simplicity because, we want to make it easy for third parties and investors to understand businesses that they're investing in. And complexity is, these are all intelligent people making these investments. They'll figure it out. But what we want to do is accelerate the time in which they need to actually figure these things out so we can, move on, get documents drafted, get the investment done, and get closed so, founders can get back to building businesses. So simple capital structure, like I said, I usually go a class of common shares with 2 series, voting and non-voting. It's just that. There's nothing else. Alternatively, I've seen some companies come to us where they've got this tax planning special of you're going to declare all these dividends, so we need 300 different classes of common shares to issue people, and they've got class A through Z common shares and all kinds of preferred shares and fixed value preferred shares, and it's just that is not helpful for you, especially because none of that gets used. And I can promise you, as an early stage company, even a later stage company, the reality of declaring dividends is a non-existent one, because just about every single dollar that comes into the business, you're more than likely going to reinvest it into scaling the company. If you're pulling money out of the business, that would usually be as part of a financing round where there's excess capital and you're able to use some of it to buy out existing shareholders. So, the kind of really complex share capital structure is not really something that's necessary or frankly usable in this particular industry. And then I look at, do the founders, the employees, contractors, advisors, do all of their equity allocations make sense? So, we've kind of danced around this a little bit, but, if I'm a founder and I hold 5% of the company and I'm literally the beating heart of the company and doing all the work, that probably doesn't make sense. So, that's something that we need to address. While at the same time, if, some advisor holds 30% of the company, also doesn't really make sense. Generally those allocations are much lower for those groups. And again, I totally appreciate there may be circumstances which are a reason to depart from that, but generally speaking, not a good outcome on the equity allocation side. And investors will see that too. So again, to my point before, they're going to look at this and say, well, Michael holds 5% now in this example. After this round, he's going to be diluted. All shareholders are going to be diluted by about 20%. Michael has even less skin in the game now. If we think about this company doing, 4 more rounds of financing, the average dilution for each round of financing, priced round of financing that you do, is 20 to 25%. I'm diluted into oblivion pretty much by the end of our Series D. And investors who are considering a seed stage investment will do that math, and they'll say, well, Michael has no ownership in the late stages where he's going to have to be really dialed in. So not sure that this investment makes sense to us with this cap table the way it is. There's ways to fix it, but sometimes that can be challenging. But at the same time, that goes back to my point of being really thoughtful in the early days of what this cap table looks like, what ownership looks like, founder roles, et cetera. And then I'll look at whether there's convertible securities outstanding, like safes and convertible notes. I'll look at whether the terms, make sense, if they're pretty market or standard, or if there's, a bunch of different terms that are kind of diverse and complicated. Again, not fatal, but just, more gating items for an investor considering an investment in your company. And also for you as a shareholder in these businesses trying to rationalize. So if I raise $2 million in this seed round at this valuation, what do I hold at the end of the day? we have to factor in both the safes and the notes as well as the investment. And so, where you have a gating item as a founder or as an investor trying to understand, what that post-money cap table or ownership structure looks like, that can be a problem. And then I look at, again, whether dilution's been managed, and whether too much equity's been given away in the early days, and try to make sure that we have an understanding of, why equity issuances happened, if we're going to do new issuances, what those percentages should be and why they make sense, but just kind of work through those things. And, what we don't want is kind of this lopsided cap table where founders own very little and they've got, equity issuances to other folks in the company, employees, et cetera, for, the balance or the majority of the business. Bit of a problem. And then, again, as I mentioned, these things can be fixed, but sometimes depending on how long it's been since we've gotten to them, they can be challenging to fix, and they can sometimes involve some real material tax implications as well. We're dealing with one right now, which is kind of a bit later stage, and, the way that the share issuances and equity issuances happened could have, really material tax implications for some of the key shareholders to the tune of like a few $100,000 in actual tax liability. And, not something any of us wants, obviously. Okay, so we're almost near the end here. We've got a couple of slides left, and I think everyone is still awake, which is a good thing. So I'll try to rush through and make sure I don't screw this up. So employees, ideally, and this is a tough one in the early days because, consistent with everything I've said, where you don't have a lot of cash to kind of spread around. It's kind of hard to think about paying employees a bunch of money, but in an ideal world, you have employment agreements with employees, for whatever that compensation is. The key thing that we're really trying to manage here, and this is like the key practical consideration point, is really just what your post-termination obligations are as a company. And thinking about this from both a company and investor point of view, you don't want a situation where, for example, someone gets common law notice, which is basically, an assessment of a whole bunch of factors, which typically end up leading to some significant payments when someone's terminated from the business. What you really want is kind of just the bare minimum, employment standards legislation required statutory payments, and employment agreements help reinforce that. And so that's kind of, there's a lot of value in employment agreements, but to me, that's like the key one. Because again, consistent with everything I've said, you don't have a bunch of cash as an early stage business. The last thing you want is to be paying out, tens of thousands of dollars to someone who's departed because they weren't the right fit, and having to do so only because you just didn't have the right agreement in place. And similarly, as an investor looking at this, the last thing you want is to invest a bunch of money in a business and to see, a good chunk of it kind of go out the door, paying somebody who's leaving the business, no longer providing any value. So key points on the employment agreements. And then the last slide I have here, I think, is IP. So maybe not fair that this was the last slide, because this is literally what these businesses are made of and kind of the most important thing. It's your product. And again, the product may be a combination of, code base, patents, trade secrets, know-how, et cetera. But at the end of the day, it's the thing that you sell and monetize. And so it goes without saying, without owning that stuff, you don't really have much of a product. And so it's really important that you have strong practices in place from an IP ownership perspective. And sometimes an area where we see a lot of issues, unfortunately, for companies. And fortunately, the fine folks at Innovate Calgary and Elevate IP and Alberta Innovates, amongst many other things, are great at making sure that this is a focus. And I know in many of my discussions with Innovate Calgary and Elevate IP and also Alberta Innovates, like, this is a key priority for them, which is great to see. So much so that even, as was mentioned, we've got Elevate IP funding going out of their way to fund making sure that these things are done properly, which I think is just incredible, because this can be expensive work sometimes. But really, what kind of good IP ownership practices are is kind of making sure that founders and contributors of the business, you always have this kind of pre-incorporation phase of your business where you've been kind of working on the idea, you've maybe been generating some prototypes, you're trying to suss out, does it make sense for us to actually spend money on this thing do we have something viable here to work towards? And so there's some IP generally that can be generated pre-incorporation. And so, part of the good practices here are making sure that you have agreements that not just have confidentiality and IP assignment obligations in them for the go forward, but also make it clear that anything developed prior to incorporation is transferred into the business. Because what's going to happen, and I'll go through a couple of these other points, but IP is a huge element of early stage investor diligence. And what they're looking for when they do this is, do we have a document that traces for every single person that's even touched IP for this company an assignment of that IP to the business? And we refer to that as chain of title. So like, can we draw a clear line between this person and what they've developed to the current software and product of the company? And if the answer is no, that's a problem. It can mean that the business isn't investable if that isn't corrected. So anyways, pre-incorporation IP should be assigned to the company. You should have agreements in place where employees, contractors, anyone who's touching the IP of the business or contributing to it has very clearly assigned that IP to the business. And where you're licensing in IP or using IP from elsewhere, where you're getting that contributed to your business, you should proceed very carefully. We had an example the other day with a company in the AI space that a very large corporate entity wanted to give them access to a bunch of imagery to train their model on. And they were very happy about that, understandably, because it was a huge data set that would be very impactful for the business. But the thing that they didn't appreciate was that those images being ingested by the company and being used to train their model would have kind of poisoned the well in a sense, where you've got a bunch of somebody else's IP where theoretically, based on the arrangements, anything that comes out of that training is owned by this other company. And that's a huge problem for this company, which we've worked through, fortunately. But it seems these things can be insidious in a way, right? Like, it seems like this is a great opportunity, huge data set. We'll be able to use this, but not really realizing that on the other side, you think about it as like, well, I've produced whatever results from these images as a company. It should be owned by me, but it's not that simple. And so kind of bear that stuff in mind and be very careful. And then the last point I would mention is just thinking about licensing terms. A lot of, as I mentioned, as I've said kind of consistently here, a lot of what I do is not just think about, what life looks like when you structure these businesses, today and tomorrow and next week, but, what does this look like 2-3 years down the road? In 7 years, you think the average business in this space, usually experiences an exit in, 5 to 7 years is like the typical time frame that you would see. What does it look like for a buyer evaluating the enterprise value of your company in 7 years? And if you've got a bunch of licenses outstanding which give people exclusive rights to your IP, or exclusivity within a territory with kind of no strings attached, those are value eroding terms, and there's many of them that we look out for. But we think about this as like, okay, you had $100 million business, but now because of this term, it's a $40 million business. How do we today prevent that discount and make sure that it's a $100 million business or more? Hopefully, it's $1 billion business. But anyway, so things to think about. That's it. Everyone's awake still. Good. Nailed it.